Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our last class of the day, last live class of the day, Building a Stock Portfolio. I'm your host, Kevin Horner. Today, we are going to take a little brief stroll through the major indices at the close of business, and then we're going to move into our example portfolio, take a look at what has transpired over the last 5 trading sessions, 7 days. I guess 4 trading sessions, I forget. Last Friday was a holiday, so we only had 4 sessions in there. And we're going to also make some adjustments, minor as they might be, to our existing example portfolio in terms of our exit strategies. And then finally, we will look to build a new position, a new example trade or two perhaps in the same portfolio here as we continue the discussion, the ongoing process of building out a portfolio of individual equities in the groups of the market that are providing interesting and potential opportunities for growth. So that's what we're looking to here, everyone. We're joined today by Connie Hill in the chat, so please say hey to Connie, a fantastic coach. Certainly capable of answering any of the questions that are going to come through for you all today. But I'm going to keep an eye on things as always because I want to make sure I get to some questions live and in the moment where pertinent. So please feel free to post in there for the duration of the show. We'll go about 45 minutes as we usually do. If you're not already doing so, follow Connie and me on X, Connie Hill CS, Kevin Horner CS. A good spot to find us when we're not here hosting classes for you on the channel. Now with that, let's get to the disclosures and we'll jump right to the chart. So first of all, remember everything we cover for you today should be considered as informational and educational only. We do not make any recommendations here. Even our process is one that requires your own due diligence. So even though we have a plan and a process for this class, make sure that you're using that potentially as a guideline for you, but I want you to customize your own plan, your own process as well. We also, of course, rely heavily on technical analysis in this class. Remember to think of that as merely one of your decision-making puzzle pieces, not the extent of everything you might use for decision-making, but we discourage you from basing decisions only based on technical analysis. So try and utilize a multitude of factors when we're making our decisions. All right, so with that, let us take a look. Here I'm going to bring up the S&P 500 and noting that we actually held our broken downtrend line with today's action. Now, today felt a little bit questionable, right? We had some technology sell-off, and you'll see that today's candle is a little bit uninspiring. We didn't get a follow-through day on yesterday's beautiful candle, but we also did not close below yesterday's low. Yesterday's low was 7,597 pennies, and we managed to close above it today at 7,503. Now, that doesn't mean anything other than to say that if you were bearish and waiting for your indication that the pop we had over the 20-day moving average in the last 5 sessions was possibly going to give something back, well, you didn't necessarily get that signal with today's close because you did not close below the low of a high day. And I'm only referencing the most immediate move, of course, off of this low from the 26th to the high we made here just yesterday. So over a 2-week window, or essentially only 9 sessions due to the holiday, we made a nice move of 3.5%, but we did not at least get a close below the low of the high day signal. So potentially, some traders will take this as a optimistic view, but maybe we weathered a little bit of a downward pressure storm in the form of technology selling off today. If we look at the NASDAQ 100, this is going to be pretty applicable to that same conversation. 1 3/4 negative versus only less than 0.5% negative on the SPX today. And the difference here, we opened below the 50-day. Interesting spot to open at, by the way. Notice that we've had a few tails there. I'll even zoom in on this for you, everyone. Look, tail here. This level was back on June 24. In the same vicinity, the next session, the 25th, the 26th, the 29th, following the weekend. And then we had this one last week on the 2nd. And then today's low, also all coming into play. So this could be a short-term zone of support for you, everyone, and whether or not a trader thinks that they could manage a trade real tightly, a level here, under this level, some traders get a little uncomfortable, but really under the last lows is where things probably shift the greatest. So, right now at least, dabbling at the 50-day. Bullish traders can tell their story. Bearish traders can point to the lower highs along the way. So, anyone can place their view on this chart at this moment. But remember what technical analysis does for us. It doesn't tell you or predict the future, but rather it does a better job of helping us mitigate our risk, or at least manage the risk. And under this where my crosshairs reside is a spot where many traders get even more defensive just based on the price action and the increased potential for a deeper pullback if we make a lower low, which we've yet to do. Mind you, we've made matching lows in a couple of different time frames here, and we've moved off of both. Let's see what comes next. And then finally, our Russell 2000, probably the one that's held up best here. We're still above the 20-day moving average. It looks a little different than both the S&P and the NASDAQ 100. So we're still seeing some relative bullishness here. Next step is the question as to whether we hold the 20-day, right? Do we get any downward pressure on the small caps by virtue of the potential rise in yields here? Notice yields were up today 1%, and so the 10-year, at least as it relates to the 10-year, going up a little bit in yields. Russell sold off a bit as well. So that's kind of an anticipated or maybe an expected relationship in a short-term basis. We often see that type of price movement. All right, so with that, I'm going to close down this watch list. Let us go take a look at one of the positions that we actually exited this last week. So I'm going to go to the Monitor tab. Let's see here. Okay, now on this page, we're going to change to the account statement and make sure that I'm viewing 7 days back. A week ago, we established new positions in Marvell and Zebra, and since our last class, we have been stopped out on keys and stopped out on microchips. So if you recall last week when we talked about keys, we had a questionable development because we traded what I thought was below our stop level. We didn't get stopped out. Well, now we've been officially stopped out, and I think we've now made a move sufficient to at least say, yeah, we deserve to be stopped out, right, based on where we had the stop up here. And so now that has carried through, and we've actually closed at our lowest low since our position for sure, and now we're into a potential gap zone here. So not shocked by our getting stopped out here. It'd be interesting to see if this becomes potential support on Keysight going forward. And then the other one was the microchip trade, MCHP. We had been managing this one, but we'd not done a good job of taking advantage. There really wasn't a lot of opportunity. As you can see, we built our our exit strategy against the 50-day moving average in here, and we built it as one ATR beneath the 50-day, as we do in this class, as you'll notice under my scratch pad over here with the details of what we try to strive to adhere to here. We set that as one ATR beneath the 50-day, and the darn thing just kept going lower, unfortunately. So we've been below the 50-day now for about a week and a half, almost 2 full weeks, and the recent price action has just taken us out of it. And so whether today is a good bounce day remains to be seen. Not uncommon to get a doji after some selling like this, and in this case filling a gap. And so now, this looks like a nice hammer candle. Essentially our open and close were on top of each other. Our open was 83.96, our close 84.15, so a very, very small body. And what we're looking at here could be a day of indecision where bulls are going to be a little bit more willing to step in now if we can at least trade above tomorrow, the high of today, tomorrow on a closing basis. We'll see if that plays going forward. But I try not to bring the same positions back to the table too frequently. I like to bring new example ideas across the board when I can. So it may make the list at some point down the road, but at least right now it is not. So Let's go ahead and apply back all my major moving averages, and then I'm going to open up our current account list. So here are the positions we are maintaining. Let's go back to the monitor page briefly and just highlight that we have a single position in consumer staples and in healthcare and in financials. We've got a few technology positions. The technology positions looked a little bit better when we got them going last week than they do today, but we've managed to hold them thus far. And one of the reminders I want to bring to the table here as it relates to the portfolio itself is to be thoughtful about where we're applying our opportunities. Yes, we've got 4 different sectors here. If we go back to my Market Watch page and quotes, what we're going to see on a 20-day basis is financials and the leadership, healthcare up there as well. Here's utilities and materials. You know, the utilities, materials, and real estate from a trade standpoint become a little bit tricky because they don't really move in the time frame that a lot of traders look for. Many of you traders, if you're like me, you want a little bit of volatility. You want opportunity provided in the form of volatility when you can get it. And unfortunately, these groups tend to be a little bit slower. Doesn't mean you cannot manage a trade effectively with them, but they tend to be to carry a little bit more detail than I want to cover necessarily in an equities portfolio class. We can talk about them periodically, but I'll tell you, when it comes down to finding good, strong trends that are maybe easier to trade and manage, I think we find that they are in the other areas of the market, the other sectors that are in leadership positions. So, with this in mind, even though technology has been struggling of late, year to date up 15%, obviously we've got those exit orders on our tech side of things. We will need to make some adjustments. But today we are going to look at adding an industrial position to our example portfolio. And I'll talk a little bit about that here momentarily. But let's start with a look at, just go on down the symbols here. We'll just hit up Dell and we'll see what we have going on. So we are still above or at the 20-day. Now the close today is above the 20-day, and our exit order here is at 374.87. Stock would have to sell down pretty healthy for us to get stopped out. And we don't want to make any adjustment that has us increasing our likelihood for being stopped out. So I think we'll stay the course with Dell and its current stop. Now, if a trader was inclined, they might have made this initial trade not with an exit and ATR below the 10-day, the 20-day in orange that we're using, but if the trader had a longer time frame, you may have incorporated the 50. Now in our case, we used the 20 because the 20 has been the deciding the deciding dynamic moving average along the way, right? You can clearly see how instances where we pull back to the 20 have been your chance to participate. We just happen to be under a little bit of consolidation after this big pop on earnings. That is not at all a surprise for the bullish trader, though. So a little bit of patience here could lead us to opportunity in the near future if this can at least hold the levels that we've established in here. So back above the 20 on a close. Basically, the last 5 sessions, we've only had one close below the 20 over the 5 or 6 sessions. So some would take that as a bullish view shorter term here. Weekly, if I pull this back just a little bit, it might become a little bit more obvious that this is a bit of a longer range bull flag, right? And that's not a bad development on a weekly as well. Okay. Mindful Trading Solutions. Let me answer that for you. How do you get the number of shares, the purchase price on the chart? This is actually an easy fix with the gear icon here in our chart. So I'm just going to, you see my cursor here in the center. I'll highlight that, click that gear, and then you want to move over under content here, orders. So existing open orders to buy or sell will appear when you have this check marked. So in the instance you don't want to see former trades, eliminate the check mark from the show trades box. But the orders are specific for open existing orders as opposed to executed trades. So know that there's a difference between the two. Okay? Hopefully that helps you out there. Now, We're not making any adjustments to Dell, but let's check out Dollar Tree. Dollar Tree in that consumer staples space. Here's where we picked up the shares. So this is our original entry here at 109.96, and we built an exit strategy originally as one average true range, one ATR beneath our lows, and that put us with a stop order well beneath us. Well, in the last few weeks, we have witnessed a Dollar Tree following the trend. So a couple of quick notes here, everybody. Broken down trends are often the beginning of new uptrends. And while not every uptrend begins immediately following a new broken down trend, it is a spot where some traders will start a new trade. And in this instance, that would have worked out relatively favorably, right? If you just simply said, hey, we got a stock that was in a downtrend, earnings led to a breakout, and not just a breakout, but a hold of that ever important 200-day moving average. And we've only had one minor deviation beneath it, and that was a couple of weeks following the earnings report. So a couple of reminders. One, you can add or begin a new position partially, right? You don't have to jump into everything immediately. You can build a position over time. First step, did we break the downtrend? Yes, maybe I'll begin with a 10 or 25% share position of what I normally would. And then if it moves out of that position, maybe continues upward, moves to new highs, as we did back here. You know, maybe this was an instance when a trader says on this candle, this was the 26th of June, trader might say, hey, we've cleared this month-long range we were in, right? We cleared it with conviction and convincingly here on the 26th. Maybe that's an instance where a trader says, I'm going to add to the trade, okay? Now, in our case, we aren't going to do that. We're simply going to manage our trade using the most appropriate moving average. In this case, I think it's the 20-day, because again, resistance along the way until it breaks can thereafter become support, right? So we've been supported right here, and now that the 20-day is catching up to that breakout spot, that's even increasing perhaps the importance of that zone and price right around 116. Now, so what we're going to do is take that 116.12, that's our 20-day moving average today. And we're going to do a little math. We're going to add that ATR down below. It's $4.88, and of course I'm rounding up. So we're just going to go from our 116.12, which is again our 20-day moving average. We're going to take that amount less the amount of our ATR, the average true range, $4.88. And that gives us a new price of $111.24. So right now, our stop is in at 108.57. We are going to raise our stop by almost 3 points. That doesn't mean we're locking into gaining $3 more of profit, unfortunately, because this is a market order once it triggers, but it is increasing our likelihood of doing just that. So this is what our process is, everyone. This is us taking advantage of upward movement in the short term to capitalize and increase our exit strategy, hopeful that we can hold not just the 20-day, but even some wiggle room beneath the 20-day, right? So instead of pushing this one up, which I can do, you can always click and drag. I'm going to right click and click cancel replace order, and that's going to be just for the stop order. You'll notice I've got an exit at the top as well. So up here, we are going to close our trade if we can get up to my limit of 135. We are still far away. We've still got 13 points to go. So it's important that we continue to raise our stops so that we reduce our risk. So we're going in at 111.24, which is a very nice odd number, not a 5, not a 0. I like that. We're going to keep it good till canceled. Hit confirm and send for verification. Yep, we're good. And there we go. So there we are, updated it. So again, the reason, just for some of you who might be new to this class, the reason that we incorporate ATR, again, it's average true range. We use the defaulting period here. It's a 14 period ATR. It's looking back 1 day shy of 3 weeks. But the reason we use it is that it increases the chance that if we're stopped out, it's because of true stock weakness as opposed to maybe broad market weakness. It's not uncommon for any stock in the market to have a day where it struggles or goes down when the broader market goes down. If the S&P is down, or maybe it's a tech stock and the NASDAQ is getting hit any given day, you can easily witness your stock getting beaten up. But it's uncommon for that stock to break its true trend if the stock is not going down on its own news. If it's just following broad market weakness, it will frequently go down, but find a level that's reasonable for going down, and then it bounces. And we only want to get taken out when things are really changing, right? And the ATR helps to give us that little bit of an edge. Now remember, we only use one ATR. That doesn't mean you can't use more. If you would have greater comfort with 1.25 ATR or 1.5, even 2 ATR, feel comfortable utilizing that. Again, I told you up front, with disclosures, it's imperative that we all have a plan that works for us. So don't hesitate to build your plan to suit your comfort, to suit your needs. And if your time frame is longer and you don't find the 20-day moving average to be pertinent for the way you'd like to do things, go ahead and increase your ATR. Do this process on a weekly chart instead of a daily chart. This can be done for any time frame that works for you. All right, but make sure that the process lines up with your time frame. Very important. Okay, so here we have Dollar Tree shifted. Let's check out our next position, EW. EW has been working wonderfully. Nice move higher with healthcare moving higher. So we have to make an adjustment here. Look at where the 20-day moving average is now, up through what was, let me add a little time to this for you, everybody. Look at this. So we had a beautiful range breakout here, right? The top of our range, about 88. The bottom of our range, let's call it 76. That's about a $12 range break. So a lot of traders would look at 88, add 12 to it from the range we broke from, and say you might have an opportunity to get to 100. We're only 5 points away from that. We do not have an upside target here. What we have done is bought in originally at 78.61. We took 50 shares off up here at resistance. That was our original plan. We took those shares off because we wanted to be right, even if it kept going higher or it pulled back. Well, it did manage to pull back and then went higher. And so we're still participating here. This is great for us because we've been enabled to now raise our stop even once more, right? So let's go to the 20-day. 89.01 is our new 20-day. And our ATR is $2, and I'm going to round up again, $2.48. That gives us a new level of 86.53, and our current stop is 84.94. So I'm just going to slide this higher, click and drag to 86.53. 86.51 is really close, within 2 pennies, and it's below the math I've done. Great opportunity there, so I'm just going to stick with that. 86.51 it is, new stop level for the exit strategy on EW. Now, if you wanted, a trader could easily apply an order here that says go ahead and sell at an upper limit if I wanted that. But ultimately, the initial opportunity here is maybe one that allows us to stick with this even longer. Let me see here. Good question. Okay, MC Traveler is what it looks like. What was the setup that led to the buy at 76 or 78.61, as it were? Let us apply my moving averages once more. So the process here, everybody, what we frequently will look to do is be a buyer of stock that are already in trend, which is to say trending higher above a 20-day, above a 50-day, above a 200-day moving average. And you'll see that when we look at our new example trade. But in this instance, we ended up being a buyer based on a pullback to an area of short run support. And we put an exit strategy originally that was an ATR basically beneath the lows that we established in here. And so if I recall correctly, and granted, it's been a bit, as you can see, I mean, we're back in April, so we're 3 months ago already. But it's great. I mean, first of all, it takes a lot of discipline for me to maintain a position for 3 months. So the fact that we've held it this long tells me that we managed this one appropriately. But essentially, the chart kind of looked, I think, a little bit like this. And we had these 3 days in a row where our lows were all together. And then this day was a barely close above the high of the low day. And we placed a limit buy order and we got in. So terrific that it was there for us. Maybe a lucky entrance, but it's been fantastic since, as you can see. And we've managed the trade pretty effectively. Now, I will say one other scenario here, even though the 20 is what we're working with, if the trader looked at this and said, Kevin, that 20 is way too far away. Stock has exploded to the upside. Look at how far that is. 6 points away. That's more than 5%. Just to be told I'm wrong, some of you would say, I'd rather use a 10-day. And a 10-day would allow you to have a higher stop order. Doesn't mean you're going to be better for an exit strategy, but it might work in your favor if you prefer. So a 10-day might work, or a trader could even get more aggressive on an exit strategy and maybe you work from the 5-day. But the key, as always, here's the 5-day, by the way, 93.36. The key, as always, is to be incorporating something that takes you below the prevailing moving average of your choice. And we use ATR to do that. A lot of traders will use ATR. They'll use a valuation or a calculation of ATR, but you have to do just that. You can't stick with just the moving average because inevitably you will see price violate a moving average intra-period all the time. All right? So try not to be too tight. The ATR gives us that wiggle room we're striving for and the greater likelihood of maintaining our positions. Okay, next up, Marvell. Marvell has tested our mettle today. Last week we talked about use of the 20 period moving average up here to use our ATR. We did not. We used the lows of the action since the gap higher following earnings. And thankfully we did, because that mathematical calculation brought us below the 50 period moving average with our stop, and that level today of our stop is 214.86, and today's low on Marvell was 222.94. So not in a whole lot of peril. We didn't necessarily anticipate getting stopped out on that big a move, but we're still alive, right? We got the position. Hopefully this is a bounce spot. It could be testing, holding support at the 50-day. This is the first kiss of the 50-day since it broke out back in March. So stock has been absolutely fantastic since then. You're up 140 points from early March. Wonderful. Not to know, we just don't know if we're going to hold up in here, right? We just need to give it more time. But more importantly, we're not changing our stop, right? If we wanted to elevate the stop, I guess we could, but I don't think that that's pertinent here. I think it makes more sense to let this one go, and we'll take a little look at it hopefully next week with the position sitting tight. What bulls want to see tomorrow is obviously a trade above and close above today's high of 237.44. Tomorrow, if it were to close above 237.44, you'd have a hold, and a lot of traders might take that as a reason for potential entry after having tested the 50-day. We'll see if it plays out that way, though. So no adjustments there. Let's look at Morgan Stanley. Financials have been strong of late and have been improving. If you look at, for example, the financial sector, there you go, made a huge move all the way up to the basically all-time highs, if I'm not mistaken. Sure enough. So we got to all-time highs and then we took a pause. That's not uncommon, is it? This is exactly why traders target all-time highs or prior highs as areas for profit taking. It doesn't mean you sell everything necessarily. Think back on our trade there in EW recently. But that's a nice move in financials, and Morgan Stanley has done something similar. We're working here. We had bought 40 shares originally, took out 10 of those here at 215. We're basically right back to that same level. We just need to manage our stop, and the question is what we want to work with. I think a lot of us are comfy using the existing 50 period moving average. Some prefer the 20. We used the 20 last week. And let me think here. Let's go back to the 30th. Oh, we couldn't have used the 20 because if we used the 20, I think last week we didn't make an adjustment on this. So let's just do the math on this real briefly and let's see where we stand. So if we were to use the 205.14, our 50-day moving average with our current ATR, it would need to be about 199.04. And we're in at 202.27. So we're not going to make any adjustments there. We're going to let that one slide. Hopefully what we get is a move to new highs, and then we can raise it next week. If we wanted, now that we're above the 20, if we wanted to, we could. But remember, 1 or 2 days above the 20 is by no means a guarantee that it's going to hold the 20. And if we wanted to use the 20-day instead, that number is 216.98. Less our 610 approximately, right? And that would give us 210.88. The trouble there is it's in no man's land in terms of the trend, right? It would be right in this vicinity. And so that would be, some of you would say that's exactly where I want my stop, and that'd be fine. If that works for you, go for it. In terms of management, though, the fact that you're between the moving averages increases the risk of being taken out of your position before the trend truly breaks. Most traders would look at this and say, I just need to see a close under the 50-day to validate that, right? A close under the 50-day would be the first time since the gap higher in April. And if that was your view, a close below the 50 would be a good reason. It would be something different, something new from what we have seen. And here we're trying to stick with it as long as we can. So we'll keep our existing exit on Morgan Stanley. And then finally, also added last week was Zebra. Now, Zebra, we bought in here, as you can see, 263.14, believing that we might have a broken downtrend. Look at how our prior highs took us into and even through the blue 200 period moving average, but we're incapable of holding. Well, we have managed to hold here. These have been 2 days, 3 days, 2 days, 1 day, and this one we're above now for 6 sessions. This is looking even more intriguing for us. So we've got a confluence of detail here as well. We've got the 20, 50, and 200-day moving averages all coinciding within a few bucks of each other. Certainly within 10 points, it looks like. The 249.34 and then our 50, yep, about 8 points of difference there. So you got 3 groups of traders, everybody. 3 separate traders using 3 separate time frames, a 20-day, a 50-day, a 200-day, and they're all looking at that same relative price, ballparks to 245. That gives us what we call confluence, and it can be a reason for traders to validate that price range as support now that we're above it with a little bit more confidence potentially. So we'll see if that validates us as we go forward here. Okay, the Zebra trade at the moment, our exit on our stop here is way below. So we're in at 39.38. We are in at 227.62. We're giving it about 40 points of wiggle room from our entrance, is what we're saying. Now, the 50-day here at 241.38, and then our ATR is 1030, gives us an exit at 231.08. And so we could take advantage of this. We should push this up a few bucks. So let's do that. I'll right click, cancel replace, change this to 231.08. Another nice odd figure there. Keeping it good till canceled. Confirm. 20 shares, 231. Yep, we're good. Go ahead and send. All right, so we've increased that one a little bit. By no means a guarantee that we're going to be getting out of it for profits or anything like that, but we are comfortable with the amount of risk we have there in the trade, right? And there's nothing wrong with that. Comfort is a big part of what we do as traders. We should be comfortable every step of the way, of course. Okay, before we move on, let's just take a look at the chat, make sure I've got an answer to any questions in here. Jeff D, yeah, you know what? You're not wrong, Jeff. Your idea that a customized script, a script that allows you to compare multiple sectors in this case to get a visual of all that. Some of you need that in the form of the lines on your chart, as opposed to what we commonly refer to here in this class, of course, the Market Watch sectors, looking at the sector indices, which are obviously just as a reminder, this is a public watch list here, everybody. So public here, R to W, sector indices. You can also, though, use sectors and industries. So this way you would be, you would be looking at all industry groups. But I'll remind you, this would be really helpful to locate specific industry groups. But there's a lot in this list that are no longer used, and that list will bog down the math in the platform. So what I recommend is using this list to locate the industry groups that are important to you, and then build a separate watch list of only those industry groups. That'll be all, of course, and remember, industry groups fall within the 11 sectors of the U.S. market. So it would be a perfect idea to build an industry group watch list of just the industry groups that you want to keep a close eye on, and then apply that here so that you can keep a close eye on them in this session in this manner as well, with 5-day, 20-day return, 6-month, and year-to-date, along with relative strength as well. I think that's a great idea, though, Jeff. I wanted just to call that out because I think that in many cases we get bogged down and think, oh, I just need the numbers. But if you want to, sometimes some of us need to see things a little differently. Okay, let's talk about that industrial group. I mentioned that we needed some exposure to another one of the leaders groups. Now, industrials were weak today, but look at what has occurred here, everyone. We had a big, wonderful rally off of our November bottoms from last year. Group rallied beautifully to the peak, put up 20+%. And then quickly pulled back to the 200 period moving average. That ended up being about a 12% drawdown. And then since then, we built, well, it looks to me like what we really did was kind of created a real lengthy handle on a cup and handle, right? You had a deep cup here, and then a handle that took about 2 months to resolve, 3 months to resolve almost. And then once it did, it's been on the up and up. And so if we eliminate all of that, what you could see is that we've pulled back to where else? Former resistance, now potential support. And even better is that now, even though we pulled back or held that breakout level, now we're trading above the 20 period. So you've got industrials potentially in a trending short-term situation here. Not by any stretch a bad development. So what I've done is, of course, I went into the list I built for myself via the scan tool, which is essentially just an uptrend all time frame and industrials. So I'll just remind you, this list is giving us ideas for stocks that are trading above their 20, their 50, and their 200-day moving averages. So trending in 3 different time frames. And at the close today, it wasn't this way early on, but RSG, Republic Services, is the one we're going to build an example trade around today in our final 7-8 minutes. So let's talk about RSG. First of all, on this daily chart, what stands out? I would say it's probably the 200-day moving average stands out. Let's just go with only the 200. All right, so here we have a 1-year chart. We are not just above the 200 with today's move, but looks like we're clearing the 200 with today's move, doesn't it? And we've also traded through what appears to be a pretty important level. You remember when we broke down back here and made these lows, in the midst of that real quick throwback and retest, we got paused right here at this level, 218 or so, right? Pretty intriguing that we got paused or stopped right there, and then thrown back for a matching low. Couple things. Number one, this was the ultimate low, and then we made a matching low right next to it, right there. But look at what the RSI did here, everybody. RSI at this time was down here. RSI, when we made the next low, up higher, much higher, in fact. And we've seen a bullish uptrend in the RSI. In fact, so much so that the RSI is up to 65 now, only 5 points away from meeting overbought conditions. Remember, overbought, not a negative on new trends, right? That validates the trend. So this chart stands out on the daily. And we could potentially build in an order that would get us into the trade with an exit strategy and ATR below the 200. But before we do that, I just thought I should also pull us back in our window and look at a 5-year weekly. Here we have a 200-week moving average. That's the blue line at 190 approximately, 188.5. And boy, when you look at this over a much longer term window, and knowing that we had a bullish divergence at those last lows, look at what we're talking about. We're talking about a support test of a 2-year level of support. This goes back to August of 24, everybody. And in fact, if we wanted, we could go back even a little further when we were figuring it all out. Because at one point, these were all-time highs from March through June, July of 2024. Those were all-time highs. And what do we know about all-time highs or any high? At one point, it was resistance. Once we broke it, it became support. That's exactly what we're seeing right here. All right. So if your time frame is such that you want a position that's holding a long-term trending dynamic moving average like the 200-week moving average here, perhaps this stands out to you as well. Now, all that said, let's jump back to our daily. Let's incorporate our planning process with our scratch pad and let us build this trade. We have a tolerance for $1,000 maximum loss. And we know that. We have a look and belief that the 200-day moving average should be maintained. That number today is 215.17. So we're doing some math here, everybody. My apologies. 215.17 minus our ATR of 447. Okay? So 447, we're going to round that up to 448, gives us 213.69. So that needs to be our exit strategy. 213.69 is where our approximation of a stop exit will go. Now, in order to put us into the trade, the stock finished at 222. We have to give a padded limit. What if the stock rallies tomorrow at the open? It could open at 225. And if we have a limit at 222.46, we're not going to buy the shares. So we have risk here. Let's increase our entrance to 225. Yes, that's higher, but remember, it's an or better order, okay? If it opens at 224.10, we're going to buy pretty close to there. We're not going to pay more just because we are willing to do so. It's this price or better. So the math is from 225 down to 213.69. And so that risk is $11.31 per share. All right, so just make note of that, $11.31. So we're just going to take our $1,000 maximum loss and divide into it by 1131, and that tells us how many shares we can own. And it says we could own as many as 88 shares. Always round down. And then we have to do the math to make sure that we do not put ourselves in too big a position. Well, one thing I noticed right off is our position size maximum is $10,000. Well, we can't have 88 shares at 215, unfortunately. It's almost 20 grand. So we're going to need to cut that in half. So let's go with a much more reasonable 40 shares at a new entrance of 225 or better with a stop at 213.69. And I will do so with a right mouse click here. Go to buy custom with stop. Now remember, if you want to set a limit target above, you absolutely can. All right. We're going to simply buy it with a stop for protection, though. So we're not going to set an exit limit. We're just going to set an exit stop order. All right. So the limit for tomorrow will actually make it good till canceled. So if any time over the next 7 sessions or 5 sessions, excuse me, we can buy at 225 or under, we will. If we purchase, we will subsequently have a good till canceled traditional stop. Remember, the basic stop is a trigger. And then once triggered, it becomes a market order to sell, which means we do assume some risk here, everybody. If we buy at, if we get ourselves into the position and the stock opens one day after having closed above it, opens the next day below our stop, we have a market order to sell. And if that opening trade is maybe 205, we're going to execute close to 205. We are not going to execute close to 213.69 by any means. So it's important that we keep that in mind. All right. So again, our position size, we can't buy more than 40. So, well, we shouldn't buy more than 40, that is, according to our math and process. So let's take a quick peek here, everybody. 40 shares at a limit of 225 or better. If we buy at 225, our position size will be just shy of 8,900. And cost of our order or our exit thereafter, 40 shares at 213.69 becomes a market order once triggered. All right, there we are. So interestingly enough, everybody, if I zoom in on that, so the low here we made just on last Thursday, as it were, was 213.98. So we would at least, if nothing else, we'd have to trade under that, right? So that actually, did I do the math on that right? I don't think I did the math on that right, everybody. I got to back that up. Hang on, before we wrap this up. I was using 222. No, we got to use 215 for our math. So it's 215 less the ATR. No, that did come out right. 211. Guys, yeah, that's right. I'm sorry. That is absolutely accurate. I thought I made a mistake. Sometimes I thought I made a mistake and then it turns out I was wrong. How about that? So that order is good, working against our 200 period moving average at 215. Well, that was hilarious. Okay, make sure you watch back today's final 2 minutes because that'll make you giggle a little bit. Hey, we're at time. I want to thank you for being here. Thanks for your questions and for your attendance, of course. Remember to follow us on X, subscribe to the YouTube channel here. We get this into the archive for those of you who would like to rewatch. It'll be probably either late today or first thing tomorrow when it gets into the archive. But your thumbs up on today's session would help us out in the replay for that. So thanks for being here and for participating in the show. Thank you to Connie. Hope you all have a fantastic rest of your Tuesday. I'll be back with you tomorrow morning for Trader Talk at Market Open. Have a good one, everybody. See you soon.